Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So I just recorded a video that was slightly longer than the usual. It's about 30 minutes long, where we talk about companies that are high quality compounders and so on. And I talked about why I haven't posted anything for the last few weeks and so on. So when that comes out, you will listen to that. But right now I'm just going to give you a quick summary. This is the portfolio, my portfolio, which has been up and down over the last whatever weeks, just like everybody else. Has been in the negative. Has came back. The last 24 hours is up about over £3,000, and probably by the time the market opens today will be down another 7%, £7,000. That's just been the case over the last few weeks. So yeah, I'm going to continue holding on to the companies that I have. There's 26 companies. I will be doing a full portfolio update inshallah very soon, and I'll share with you guys some of the sales that I've made, some of the buys that I've made. I've got rid of basically 2 of the companies that were in my portfolio for quite some time, and I trimmed another ones, and then I used all that money to invest in companies that I felt like they were undervalued so much right now. So I've done a bit of a rebalancing, if you like, and I'll share that with you guys in the inshallah the next few days. I'll still be posting things on the Patreon account. I think I posted a couple of days ago. So if you still want to join us, feel free to do that. I will have a lot more time, like I said in the last video, inshallah, in the next few weeks to actually start posting regularly. So yeah, like I've always said to you guys, it's just been absolutely amazing to share my journey with the community. And right now is probably a good time to keep posting and find these undervalued stocks that we always talk about, and high quality businesses, and just tell you exactly what I'm doing and what I should be, what you should be doing in the long run and so on. Again, if you want to make money in the stock market, right now is probably the really good time to start buying and accumulating as many high quality businesses as you possibly can while things are still on discount. If things get worse for the next few weeks and months, then keep buying them, because in 10-15 years from now on, you can look back and thank yourself the fact that you've actually stayed on track with your investment goals and so on. Let's now talk about these 7 companies, but before we do that, I just want to show you quickly, because of this, this is what we were used to basically over the last couple of years. Every single week the stock market was going up. Every single day we'll probably see about 0.5%, 2% up, and then at the end of that week we were up about 2, 3, 4%, and then the next month comes, and then this stock, and then at the end of the year we had 20-something% every single year for the last whatever years. And that is no longer the case right now. This is the situation for the last 3 months, and there's more reds than actually green. And it is uncomfortable. It's not great to see the companies that you own in your portfolios that are down 30%, 17%, 30% as well, 25%. Like, all of these companies basically are part of our portfolios. Whether you buy individual stocks or ETFs, is basically everybody's feeling the pain. If you buy individual stocks, it's even more difficult, because, for example, if you have AMD and you're down 30%, but if AMD is part of one of the ETFs that you own and is only 2%, basically you're losing the fraction of that, basically, in comparison to 30%, if you like, of your money. So yeah, buy the ETFs if you don't want to buy individual stocks. But what I'm going to do today is share with you guys what I believe is high quality businesses, 7 of them in this, and they are undervalued at the moment, or on the basic verge of becoming undervalued. Okay, and then I will give you a little bit overview about each one of the companies. Right, the first one is Novo. Novo has been undervalued for quite some time. It's gone down so much. If we go on here, a year to date is down 30%, which is absolutely it is a lot. I'll be honest with you, is a lot. And as you can see here, they do have some nice dividends and so on. But when it comes to profit margin, return on equity, return on investor capital, probably there's not the many companies out there that have that sort of a high quality free cash flow of $10 billion. And they're expecting the earnings to grow about 32% and 31% when it comes to revenue. And right now it's about 50% upside from where we are, almost 50% from where we are, which is absolutely amazing. Now, if we use the fast graph to kind of see where the company has been over the last whatever years, for basically since 2005 up until now, as you can see, the orange line is basically the earnings, the fair value for this company, okay, and the blue line on the top here is basically what the market likes to value this company. So the blue line has been about 24 on average, and the orange line is basically about 17. Now, As you can see here, the company's been absolutely fine all these years and slightly higher than the base of the normal, and it came back down again in 2016, and then it gone up again. This is why the earnings, the fair value should basically the price of a company should normally track the earnings basically of a company. And 20 when COVID happened, the stock came down quite a lot, and then it bounced back again up there, and then look at this. And then because of all the Ozempic situations with all the weight loss and so on in 2024, things have gone absolutely crazy. And if you were like me and you bought at the top, you'll probably be losing right now about 63% or whatever on your investment, which is absolutely crazy. Now, if I shorten this, okay, now watch what happens. Last 10 years, we expected, basically we had about 16% when it comes to earnings growth rate. But when we look at the last 5 years, we're looking at about 25%. And a lot of that is because of the weight loss situation. Now, if you buy this stock right now, okay, you are expected to make about 36%. Now, that's basically based on this. Now, if you look at the earnings forecast for this company, right, the fair value is about 18.5. The operating earnings growth rate basically is about 18.5. Now, if that happens, we're making about 23% on basic return on invested capital, return on rate of return basically on our investment. So 10,000 investment right now in 3 years will become about 17,500 pounds. So you'll be making basically 7,500 in about 3 years, if that's the case, if you invested $10,000 in this company. The normal PE for this company, we've seen already slightly higher than the fair value, okay? And that, if that happens, which is about 30 right now, we'll be making about 47% per annum. So every single year, your rate of return will be 47%. So your 10,000 investment will become 28,500, including 1,000 dividends basically. Okay, so wherever you look at, this company is basically expected to do well and overall, and it seems very much undervalued, and hence why I'm buying more. And inshallah, I'll be sharing with you guys when I do a entire portfolio update. The next one is AMA. AMA is basically applied material. One of the companies basically that been hit hard over the last whatever months, and as you can see, it's down. If we look at year to date, about 15%. For the 1 year, it's down about 27%. It's coming back to that 52-week basically range. Now, if you look at this, it's about 40% upside from where we are. $193 per share is where they think the price should be. Looking at fast graph, as you can see here, historically the company has traded slightly higher than that orange lines and blue lines, and okay, over the last whatever years, 11% when it comes to that growth side of it, for normal PE of 15. If we look at the shorten that basically last 10 years, as you can see, it's been very much overvalued basically in 2024, and since then it has come down quite a bit. In fact, the best time to buy this company was when basically it was around here. Imagine if you bought it there and sold it, just say there, 48% basically per annum. That's what you would have made, which is absolutely crazy, right? And but right now, if you bought it there and sold it right now, you'll be losing about 48% as well, which is crazy. So that's why it's important to buy companies when they're undervalued, when they're trading below their intrinsic values. Because remember, earnings are important. Companies' prices should follow earnings. If the company is not making enough money, right, how are they supposed to go up? It makes no sense. You can't tell me you're gonna go to basically someone who's selling their business and say, okay, can I buy your business? And they say to you, yeah, well, but then you need to know how much basically, how much profit they've made, whatever the company over the last whatever years, what they expected to make. Do the numbers first and say, okay, based on what I've seen, I think your company is worth this much. But a lot of us are just buying blindly, just going and buying these companies blindly. But if you look at the last 5 years, for example, we expected about 7%, which is not really great, right? But that 7% will give us, okay, if we look at let's go actually to forecast, and I'll show you in a second. So that PE is of 15 and 7% growth rate, earnings growth rate, basically will give us about 7% return, which is not bad at all. When we look at the normal multiple, what the market likes to value this company, again, about 13%. So not great, but it is still undervalued. But according to Morningstar, it's slightly bit more than that. Okay. Salesforce is the next one. Currently expected to be $315 per share. Right now it's 243. That's about 29% upside from where we are. Again, another great company. Excellent free cash flow. They expected the earnings to grow as well. If we go to fast track and check this one out, if we go to Salesforce, click history and click max, for example, you would see over the last whatever years, if I just refresh this, since 2006, you will see basically they expect the earnings were growing about 32%. The fair value was about 34%, and then the normal PE for this company was 95, right? Then last 10 years, okay, this probably was around the best buy. Let's actually go back and see when the best time to buy this company. Okay, around here, around there, 2020. This is when COVID, after we came back from COVID, everything went to the moon, and then 2022 we had that tech bubble thing that happened. Tech companies were down a lot. That's when the best time to buy was around that time, and the next best time to buy is right now, right? So if you buy it right now, you'll be making about 28%, 29%. If we look at the forecast, and that's basically based on that, all right? Now, if we shorten that time, 10 years, okay, still seems undervalued, okay? Last 5 years, their earnings basically were growing about 22%, 23%. Normal PE for this company was about 33%. Now, that gives us, if we move forward to look at the forecast, for example, for this company, if we look at the normal PE, we're losing about 3%. If we use the multiple, normal multiples for this company, which is about that 40, which is too much, is about 37%. Now, let's say normally we want less than that, 28%. Even if we go to 20, you still be making about 7%. Okay, half that, you will still be making about 7%. So it seems undervalued right now based on this. So I will definitely be adding to it whenever I get a chance, and in fact there's a bit of an update I'm going to give you guys inshallah next video. AMD is another one, 62% basically upside from where we are. $140 per share is where they think the price should be. If we look at the AMD in here, one of the things that you will notice is also, if we look at the max, for example, the best time to buy was around here, basically when it was below that orange line and so on, and then it became crazy and it's gone up so much. The last 10 years basically the growth rate has been 46%, and as you can see the fair value has been 46, and the normal P is about 52. Last 5 years, okay, when we look at the last 5 years, you can see about 17% growth, fair value about 17 and 36 P when it comes to that. Looking forecast, for example, looking to the future, as you can see the analysts that are expecting about 45% upside from where we are. Okay, even if we go down to 21 or even 18 PE or even 15 PE, whatever, it's about 12%. Now, if we click the normal multiples, you can see, which is basically what the company has been trading, which is about 53. That's 78% upside from where we are, which is absolutely ridiculous. So another one that seems basically undervalued at the moment. TSMC, another one that I would like you to have a look at as well, is 80% upside from where we are, which is absolutely crazy. So if we go on here and look for TSMC, one of my favorite companies of all time. I wish I could hold it in this portfolio and basically trading 2 on 2, but I can't for some reason. And yeah, let's have a look at the basically over the last whatever years. So the last 19 years, as you can see, about 17% upside, 17% at an earnings growth rate. About normal PE was about 18 when we look at the last 10 years. And again, the best time to buy was around here, 2022, when things were down. At the time, it had a PE of 10. That's basically, that's why sometimes PE, you know, it is important to look at it, but not just based everything on just that. So if we look at the last 10 years, look at this. Okay, as again 19% earnings growth rate. Last 5 years about 15%, 15 fair valued, and 20 when it comes to the normal PE for this company. As you can see here is AA minus grade, is 785 billion market cap. It has a small dividend of 1.3 and the earnings EPS yield of almost 5%. So the last 5 years basically that's about 14%. Like if we look at now for the forecast for moving forward for this company, you can see the adjusted operating earnings growth rate of basically about 20. Now, if that was the case, we would be making about 22% on our money, which is absolutely amazing. If we look at what normal the Master Market likes to price this company, as you can see here, 25 is the number, 25.9. You'll be making about 34% to basically total annual annualized rate of return, which is absolutely amazing. Now we have two more companies, and the next one is one I own in my portfolio. It seems right now basically it's just fairly valued right now. It's not undervalued yet, but potentially if the markets continue to decline, we might be able to see this company actually do well. Now, one of the things I want to mention is the fact that they're expecting the earnings to decline, and I've seen this with a very cyclical business, of course, because it's a because of the type of products that they sell. And now, for that reason, this I've seen it before where they had a negative earnings for a couple of years, but they bounced back. Now, if we look at CMI here, CMI, and we look at historically, we look at the max, for example. Here we go. As you can see here, over the last whatever since 2005 up until now, you can see how cyclical basically the price has been, and earnings as well, basically up and down every couple of whatever years. Now, if we look at the last 10 years, it's about 10% growth, 15% when it comes to fair value, and also normal PE has been almost the same. So these two lines, the orange and the blue, has more or less stayed the same, which is actually quite good, because normally the blue line is higher simply because people are thinking this company is going to do way better than it actually has been. Okay, and paying higher multiples for that, for the stock price. Now, if we look at the currently, okay, from where we are when we're heading, if we look at the orange line, we're basically expecting about 17% when it comes to rate of return for our money. So 10,000 will give us about £15,000. Okay, and when we look at the earnings expectations, 15 again, about 16-17%. Normal multiples will be almost the same, because that's exactly what we're expecting, again 16%. So I think genuinely this company is undervalued, but I think I would wait, just get a little bit more cushion, maybe get another 5 to 10%. And last one we're going to talk about is basically Arista Networks. It's a company that has been on my radar for quite some time. As you can see here, they're expecting decent growth in the next couple of years, 19% upside from where we are according to this. If we go on here and type ANAT, for example, let's see what comes up. History wise, if we click max, for example, as you can see, the company's been around this time was probably the best times to buy. It's been up and down that orange line, and then it's gone so much up over the last 3 years. Look at that, it's been absolutely ridiculous, but now it has come down again. Now, if we look at the last 5 years, okay, as you can see here, the earnings basically has been about 14%. So earnings growth rate about 14% of 24%, sorry, which is absolutely amazing. And if we look at the forecast for this company, this is the way I found it really interesting. As you can see, the normal estimates, basically you will be losing about 8%, 9% every single year. But if we then say, for example, normal multiple, which is basically what this company has been traded normally for the last whatever years, then you will be making up about 23%. And this is why you need to make that decision for yourself. If you think the company is going to basically it's going to trade similar sort of normal multiples over the whatever years, then you'll be looking at about 23% upside from where we are. But right now it's about 19% upside from where we are. I would definitely say maybe just wait for another massive drop. If that happens, maybe if it hits about below $60 per share, then probably will be interesting one to look at. Anyway, that's the 10 companies I want to share with you guys, the 7 companies I want to share with you guys today. The Sharia compliance side of things is basically this. The last video, I forgot to share the Sharia compliance side of things. I did the research, but I completely forgot because the video was so long. I think it was almost 30 minutes. But yeah, if you watched that video, apologies. But majority of the companies on that, anyway, not majority, all of them are Sharia compliant. All of the ones that we're talking about today are all Sharia compliant, according to Zoe, Sharia compliant side of things. Anyway, I hope you're enjoying this type of content. If you are, join us when it comes to this journey, inshallah, and buy high quality businesses, hold them for a very long time, buy them when they're undervalued so you don't lose money. Again, this type of thing can easily happen. People will buy stocks when they are up here. Okay, let's go back here, when they're up there. Okay, and then maybe sell it now and then lose about, 1 or 2%. Now, if you sold it by the next 3 years, if you sell it and this happens, that's fine. But if you bought it around here and sold it there, then you will be losing about 92% of your money. But if you bought it, if you're a long-term investor and you bought it around there and you sold it when it basically becomes too overvalued, that 10,000 investment in 2016, not long ago, 2016, right now, you would have made, if you sold it right at the top, 213,000 US dollars, 46% every single year on your money. So that's the type of things that we should be doing, not just buying companies when they're right there, and then as soon as the market goes down 5%, we start panicking and we're selling everything. That's where you lose money, and that's why retail investors lose a lot of money. So change your psychology. I've read this great book called Psychology of Money. If you haven't read that, genuinely read it. It will help you stay calm and think about long term, inshallah. Anyway, I've got loads of videos planned for us in the next couple of days. Have a wonderful day. Assalamu Alaikum.